Welcome back to Good Returns. I'm Matt here with Garrett. Happy Memorial Day week to everyone listening. Definitely a holiday shortened week. We didn't have trading on Monday, but we had a lot of things occur.
9 consecutive weeks of gains. We should have like a,
Yeah, keep
it's
score.
a big deal.
Yeah.
9 consecutive weeks, all-time highs almost every day. We have yields reversing lower. Word came from financial press that we want to address later on in the podcast, but we'll be talking about the S word, which is stagflation. Stick around for that. We're going to explain what it actually means, where we actually are, and why it matters. And here's the deal. We're not going to catastrophize it. We're not going to make a big deal out of it. But it does warrant an explanation.
Yeah, absolutely. And in the planning room, yields pulled back meaningfully. 30-year dropped below 5%. So if you have a mortgage, that's a conversation worth having right now. So we're going to give you the framework for deciding whether you should or should not refinance on that meaningful pullback.
Yeah, a question we get a lot, actually. A lot of practical stuff today, but before we dive into it, everything on Good Returns is for educational purposes only, and nothing we say is personalized financial advice to you. We are here to give you context and help you think more clearly. We do work with clients of our own, so we may or may not be your financial advisor, but if you have questions, if you need help, feel free to reach out. Happy to help.
Let's get to it.
All right, I said it before, but 9 consecutive weeks of gains. I'll say it again in case nobody heard it. The Dow, S&P 500, Nasdaq, all of them closed at all new all-time highs. Story this week is that the rally actually broadened a bit, which is something that we're happy to see. We've talked in previous weeks about the narrowing of that and how those tech companies kind of raise the indexes and leave all the other members of those indexes behind. And this week we actually saw some movement in small caps. You got your equal weight S&P 500 that set new highs too. So this is kind of the most encouraging breath signal that we have seen in a few weeks.
Yeah, I mean, for a little context, we've been talking for, the past month about the rally becoming more narrow over the last 30 days, and you can see that. You had a handful of large tech companies doing the heavy lifting. The rest of the market lagged. This week, that changed. When the Dow, the small caps, and the average S&P are at records simultaneously, it's building a healthier picture. We're seeing that in our own analysis in the data. The most important thing to keep in mind when you're constructing a portfolio for the long term, you want to have a good, strong framework, a good, strong process of how you rebalance and how you rotate. You have to build that out with durability in mind. So when we talk about small caps and we talk about equal weight, that's a component. When you look at the data and you look at risk reward and you look at what the possibilities and probabilities are, it's very good to see that reinforced with, and generally in a V recovery and a sharp recovery, you're going to have that narrow. Mm-hmm. You're going to have that, but then you want to see that gap collapse. And depending on how the portfolio is constructed, maybe even invert, maybe surpass where you build a positive above what just a handful of the market-weighted indexes are doing. So very, very healthier picture, kind of getting back to April. All right. So
yeah, we've seen it before this year.
April was the story. Well, really, January to April was the story of your smalls and your equal weights really doing some really good work in your portfolio. And then May, we had a little bit of a reminder of last year, but we see that beginning to compress, and that's a good sign for a durable bull market.
Yeah, like you said, technology still led. We have defensive sectors and energy lagging as the market rallies on the diplomatic progress in the Middle East. Also, you see falling oil prices, which you've been a proponent or a seer of for the past few shows.
That seer.
We had the VIX drifting lower also as tensions cooled. So all of this is, yields reversing meaningfully. All of this is sort of signifying potentially another sort of risk-on type environment where we have sort of been, I don't even know that we would necessarily say we've been in a risk-off environment, but we've certainly been in a more cautious environment.
Headline-driven, cautious.
Yeah. There you go. That's right.
If it bleeds, it reads environment, which is not unusual. And if you've been in the market for any period of time, even in your 401k, you see how things in the short term react to that.
If you look at your 401k.
Yeah. Which is good. You should, some. But you have to know yourself too.
Right.
You're right, tech-led. And I will say there has been a quietness, a I don't want to say ignoring, but definitely a subtle silence on one part of technology since October that the headlines haven't picked up on. And I think that narrative is about to flip, and it's about to flip very hard, and that is crypto. Because of the Clarity Act, some regulatory changes that will become cemented into law. Looks like the Senate has reached a deal, the banking industry, along with the large crypto infrastructure companies, talk about Circle, talk about Coinbase, talk about Kraken, those guys, they seem to have come to a compromise, an agreement. And I believe that part of the technology that's kind of been lost in the narrative since October I'm predicting, maybe I'm using my seer skills. I believe that narrative is about to flip hard, which is going to be great for portfolios exposed to those disruptive technologies. Oil did pull back. You're right about that. Second consecutive week, it is now in the 80s. For anyone keeping score, that's the variable that I've watched very closely, and it's moving in the direction that I expected. And we'll talk about what that means for the broader kind of short-term inflationary story that we've been experiencing. It's going to be very interesting. But yeah, we're in the 80s today.
Yeah, I go back to what you talked about with crypto, but because we kind of talked about that before we turned the mics on. But crypto has these cycles of being in what they call crypto winter, or a pretty stout pullback from time to time, every few years or so, before it, jolts forward. And so the question then is, how do you know when you're at the end of one of those? And when you're gearing up for another leg up? We had, Bitcoin specifically reaching like 120 at maybe 124 was the all-time high there, and dropped back down. A lot of speculation that we'll see another leg down before we see another leg up. There's kind of all different thoughts, schools of thought there. But it is a much constructive picture even than it was a few weeks ago for that specific sector. If you're looking at, specifically the larger ones, Bitcoin or Ethereum or, Solana or something like that.
Yeah.
But there are some positive signs there. And we've talked about it before, I think, on the show a couple of weeks ago. But
there's a few different things that you can look at. You have to be disciplined, but yet open-minded when it comes to blockchain technologies. So we've had exposure going back to 2023 in our clients' portfolios that have done wonderful. We know we have a good framework, a structural picture of where those prices are going to go. I won't make any predictions, but it's substantial. And so you have to be disciplined through those downturns because you know where the price is going to go. It's S curves on top of S curves on top of S curves. The adoption rate, the interface of artificial intelligence and blockchain technologies, the use cases there are mind-boggling and substantial. When you speak about Ethereum specifically, you have your AI agent use case, but really the most powerful use case, which is going to begin to dominate the headlines this year, is going to be the disintermediation, if I said that correctly, of the third-party payment systems and the tokenization of assets, which is Wall Street is moving full steam ahead on that, and it's substantial. So you have these crypto winners that have historically been driven by Bitcoin's halving cycle. This last halving cycle we went through is proof that is becoming a diminished factor in the cyclicality of crypto. And I believe that as we go through this next cycle, crypto is going to be more closely driven by the business cycle, which is
it's certainly more widely available in these ETFs, platforms, and the like. But go back to Ethereum. So why would Ethereum be something that's affected by the tokenization of assets, whether that be assets that you can buy or assets like deposits at a bank, for example? What is the catalyst there that would say, Ethereum might be something to keep an eye on in that conversation?
Well, let's go to the the base simple use case. So we won't talk about dApps, decentralized applications. We won't get into that, or decentralized finance, which those are huge.
Yeah, just at a high level, just an overview.
So when you think of tokenized assets, what you think is a digital title to an asset. Okay, so when we talk about stable coins, that's essentially tokenized dollars. Okay, they're not IOU in the sense of you go to the bank and you may have your debit card, you pull up and it's digital money. It's really an IOU from the bank, and the bank is using that to lend out to individuals, and in some instances, they may have excess deposits placed at the Fed and earn the overnight rate on it or lend to other banks, but it's an IOU system. With stablecoins, you're tokenizing treasuries, short-term treasury assets. So it's really like a direct line to the asset, and it removes all of the middlemen, and there is no bank involved. You hold the asset if you have a Tether or you have a USDC. You own that tokenized asset regardless of where it's at, whether it's at Coinbase or Kraken or a wallet at SoFi, et cetera, et cetera. You own a tokenized piece of that treasury, and so it cuts out the middleman.
But it also moves differently.
Yes, because there is no intermediary. Right. Whereas if even through Zelle, if I send you $100 through Zelle, it has to go from my bank through the Zelle system, through the Federal Reserve System, to your bank, et cetera, et cetera. There's a lot of steps and processes involved. If you Cash App, it's going from your debit card to Cash App to Square, their payment processor. Then it's being sent to the receiving debit card.
And everybody's getting a cut of that as it goes on.
Cut. And it's slow, and there's a lot of money involved. Well, if I send you Tether or USDC, boom, it's over.
Yeah.
It's
so
tokenized.
The adoption that's going to happen within the banking infrastructure, eventually will have it to where you don't need these third parties to do sort of an instant person-to-person transfer. It's just going to be natively done.
It's natively done, and you're talking about everything from real estate, U.S. Treasuries, bonds, gold, private credit, art. You're talking about stocks. That's currently being happened. Kraken is the first custodian to get an agreement with the Nasdaq for true tokenized trading of stocks.
I think Robinhood's trying to do something similar.
Yeah, that's a big deal. That removes so much opaqueness and cost.
It's just also more convenient.
Oh yeah, 100%. And it's direct ownership. Think about it the way it used to be when you would have your share certificates. At your house or something. So think 60s, 70s, and 80s.
Nobody knows what a share certificate is anymore.
But you'd have the shares, and that you own those shares, right? Yeah. Here's my paper. This shows I own it. It's like that, but digital.
Right.
So it's pretty incredible. And 65% of all on-chain, what they call real-world assets, which are these things that are tokenized, are on Ethereum, and it's expanding extremely rapidly. If you look at the dollar amounts, and it was a publicly traded company, it would be mind-boggling. So, the use cases just go on and on and on, but you just have to think about the Ethereum has the first mover advantage, and it is proving its use case, and it's being implemented by BlackRock, Franklin Templeton, JP Morgan to become the global settlement layer for transactions. That immutable, trustless, no third party needed settlement layer. And that's why you have the players that are going to have a hard time competing, whether it be record keepers on Wall Street, different brokerage firms that these things pass through, or whether it be Visa or MasterCard. They're adopting it because they realize that they can, there's a chart that I've worked on that I have here that I was going to do a webinar on. I haven't done it yet, but it's like 99% cheaper for MasterCard to use Ethereum for the payment systems. And that's a big deal. So anyway, it's very
something
interesting.
to keep an eye on. You're going to hear probably a lot about it over the next 12 to 18 months.
I think so.
Tokenization of assets. That's going to be a big kind of buzzword. But we don't want to spend a ton of time on it. It was kind of like a takeaway. But let's get into the actual substance underneath kind of what happened in the market. So we had 2 data points land this week. And they're sitting next to each other, kind of worth looking at and taking seriously. The first is the April PCE index, which is the Fed's preferred inflation measure. Came in at 3.8% year over year, highest reading since 2023. And the second one was the first quarter GDP estimate, which was revised down to 1.6 annualized growth versus 2, which was the initial reading. So just kind of spend some time here, talk about what those mean and how to interpret that.
Yeah, I mean, slower growth, still elevated above the Fed's preferred target of inflation, hence the S word.
Yeah.
That's being used.
The S word we're calling stagflation. It's starting to show up in financial commentary recently as of this week. I think it's worth expanding a little bit on and explaining kind of what it means. A lot of people, may have lived through it. If you're listening to this, it's one of those terms that gets used a lot without fully being unpacked to what it means and in the context of it.
It's a buzzword. So tell us the buzzword.
Yeah.
Tell us the meaning of stagflation.
So stagflation is what you have basically when an economy experiences slow growth and also high inflation at the same time. Normally, those two things don't show up together. Inflation usually reflects sort of a hot economy where demand is strong and maybe prices are rising. People are still spending. Stagflation is different. It's prices rising even as growth stalls or really slows, to be honest with you.
Yeah, and the reason people would consider that a difficult situation, or the reason it was a difficult situation, is because the Fed's normal tools work against each other. They're in competition with each other in that environment. So if you have the economy slow and you want to stimulate growth by cutting rates, which makes borrowing cheaper, encourages spending. But if inflation's elevated and you cut rates, you risk pouring fuel on the fire. And if you raise rates to fight inflation, you slow the economy that's already weak. So this is the 70s.
Yeah, with the 70s was a good example of it. You got an oil shock, slow growth, high inflation, Federal Reserve struggled to respond effectively to these kind of metrics and variables. And you had Paul Volcker taking a really kind of aggressive rate hike cycle to finally break the inflation's back in the 80s. But it came at a cost of a pretty significant recession. So is it the same? Where are we looking at? Yeah, why are people bringing that up right now?
Well, they're bringing it up because of the revised GDP and the fact that we did have a bump up in inflation. But I will say this is not the 1970s. Obviously, it's 2026. The 1970s was very unique. And this is why I think this is going to be good to hear and talk about, because it's going to take the sting of that word out the more it passes around in the headlines over the next month or two. The 70s was driven by major supply shocks. The OPEC oil embargo. At that point in time, we were very dependent on oil for the economy. And not only were we dependent on oil from others, each unit of economic growth was around 600% more dependent on oil then than it is now. So it was a much, much bigger deal. You also had loose fiscal and monetary policies. So you had large budget deficits from the Vietnam War and the Great Society programs being kind of in their infancy and being started. And then something most people don't talk about is you had the end of the Bretton Woods gold standard. So that automatically devalued the dollar before the petrodollar was really established. So you had this kind of reset period that was going on where you had dollar devaluation, large budget deficits, supply shocks that were going on. And the Federal Reserve had previously kept the monetary policy too accommodative for too long. It's in part one of the reasons why the Bretton Woods system ended. But the money supply was being expanded faster than the economy could absorb it. One more layer. Now, it's be a wage price spiral, but forget that. It was a demographic issue. You had the children, you had the baby boomers, the children of those that came back from World War II, which is still the largest generation in the country. And what were they doing in the 70s? They were graduating high school. They were graduating college. They were wanting to buy a home. They wanted to get a house with an air conditioner and a refrigerator and all the things that the booming economy of the 50s started, producing and making commonplace. That produced a significant demand that supply could not provide for. And what are you doing when you buy a house? What are you doing when you buy all these things? And you're the first one in your family to go to college or to get a good union job in the 70s is you want to be paid a wage that you can afford all the stuff that you want. So it was demographically driven supply shocks and the gold standard being completely eliminated that really created that perfect storm that forced economists to kind of rethink the model and led to what Paul Volcker ended up doing, getting rates as high as he had to get them, nominally as high. And we're really not. We're not in that environment whatsoever. There are things that are happening.
Yeah.
And there are things to pay attention to for sure.
Well, we had a revision of growth, but it was still growth. So we had 1.6 as the revision from 2%. So it's not like we're revising from 2 down to -2 or something like that. Earnings are still, we're seeing earnings reports. They're still strong. Consumers are still spending by all metrics. Labor market seems to be holding. So, I mean, there are a lot of fears around that. I guess that's why it's coming up in the news.
Yeah, but you even had Powell, who I think was really too hawkish, in my opinion. But you even had him in March, one of his last public statements. This is far removed from anything dealing with the 70s and stagflation, and the structural support of the productivity boom. Is not the main reason, but it's one of the main reasons. It's at least 50% of the reason why we're not in the 70s. But you're going to hear it. We want to prep everyone. You're going to hear stagflation. You're going to hear commentary on it, and just always take it subtly, with context, with nuance, and we are not in that environment. But it doesn't mean it's not interesting to pay attention to, or it doesn't mean that there won't eventually be data that may inform allocation decisions that may lean towards that direction. Because you have to be open-minded to all possibilities when you're building a durable portfolio. But the situation we're in now, where the difference between having any slowing economy, it doesn't matter why, it is really irrelevant as to why it's slowing. And if you don't have productivity offsetting it, forget the monetary policy side, but the productivity gains can have a cost that's rising at 5%. And so the central bank cannot, even if they wanted to print inflation just out the wazoo, when you are entering a productivity boom era, it is very, very difficult for them to do that. There's a book on this. Oh, goodness gracious.
Had the Jeopardy music playing.
The name escapes me. But I read it. It was sometime last year that really delves into this. And it's quite significant, the productivity gains that occurred when you think about the railroad, electricity, the light bulb, planes, the highway system. It's good. It's in our favor, and that's good to see that we're in that environment now, because I think it gives those planning for what the next 10, 20, 30 years look like in retirement a high degree of confidence.
Yeah, well, if you look at core PCE too, which kind of strips out food and energy, it rose just 0.2%, which is kind of under the forecast of 0.3. So it did come in a little bit softer than expected there. So it kind of alludes to the fact that it is sort of concentrated in this energy sector, and it's all stemming from kind of the conflict that's going on over there. So it would, you could maybe make the assumption that once everything's kind of tied up and finished over there, that it would have a pretty elastic response.
Yeah, and the honest summary being, stagflation is worth understanding. You want to learn from history. You want to pay attention to the data. You don't want to have a bias or opinion affect that framework. And you have to watch it and see whether it develops into what a lot of some of the news headlines would lead you to believe, or does it depend entirely on what happens with oil? I tend to take the opinion on the latter. And you're seeing that now. There's still 100 million barrels of oil floating in tankers in the Gulf in the Persian Gulf, and oil's down $20 a barrel in the last 10 days. So structurally, not working in the oil price favor for sure. But it's important to watch the Strait, watch the ceasefire developments, and that'll be kind of your tell. As more inflation data comes up, and you'll say, okay, is this anchored purely to that, or is there something structural? Again, I tend to think that it's anchored purely toward. We'll pay attention to the data and see.
Yeah, good advice. Let's move on to the yield reversal. So let's take a moment to look at the yield story. It's kind of good context for everything we've talked about over the past month, and you've been saying oil falls, inflation eases, yields follow.
Yep.
Kind of getting some vindication this week.
I've been working very hard to make sure all of these things come to pass.
Pushing the buttons in the background.
And it's exactly what has happened. Oil pulled back second consecutive week. The 30-year Treasury yield, which touched was wrong. It's because I don't have my Coke Zero. I'm drinking ginger ale today, so I'm not getting my extra caffeine. The Treasury yield nearly touched a 2-decade high last week and quickly fell back below 5%. The 10-year dropped to 4.45%. The inflation premium that had been built into bonds unwound quickly as oil prices declined. What is that telling us? It's telling us that the money believes that this is all driven by the oil shock.
Well, it also shows like the connection between oil and yields is like one of the clearest through lines we've seen through this whole thing. And this week we've made it even clearer again. When oil fell on ceasefire news, on ceasefire progress, yields fell almost instantly with it. So you're seeing those two kind of move in lockstep.
Yeah, and as the economy absorbs it, it really lays the foundation, if this turns out to be the case, for some pretty significant deflation next year. You know, these things are measured year over year. It's year over year change.
Yep.
So if you're at a CPI of 3 or whatever, 3.5, because oil doubled, and what do you think it's going to be March of next year? It's going to be 1.7 if oil halves back to its median. So oil prices drive energy inflation, of course. Energy inflation drives headlines, PCE, CPI numbers, and those numbers influence what the Fed does with rates, or at least has been the case. There is some commentary coming from the Fed that there will be reworking a lot of how they measure this to try to get rid of the noise, which I'm in favor of. I think it would be healthy for the markets to look more at the true monetary inflation side of things and not necessarily the free market with supply and demand. So we'll see, but the Treasury yields are moving in the right direction. So if oil continues to fall, we'll see a whole reverse of what happened in the last 30 days. The fears will ease, rate hike expectations soften, yields come down, which is the trend that I think continues.
Yeah, I mean, we say it every week. It's like beating a dead horse, but the conflict over there, ceasefire negotiations, the Strait, all that stuff is still being contested. One week we get an agreement, next day it's not an agreement. It goes back and forth. But the direction is encouraging, at least. Obviously, the resolution is not confirmed. Hopefully it will be soon. We can kind of get all this behind us.
Yeah, I think so. And if you look, I've done analysis on the flows of oil and how things are adapting and changing and increasing and moving. And you take kind of the rearrangement of where the oil is flowing now, who's increasing production now, and then just add in the unbelievable, it's a step change what's happening in Asia with 2-cycle and 3-cycle transportation. With the electrification of that transportation if I encourage people, if you haven't looked at it, go look at what's happening in Asia with how quickly they're getting rid of combustion small engines. And Bloomberg has a report of, they think by the end of this year that pretty much that alone will displace around 2.7 million barrels a day of oil forever. And then the rate
demand destruction.
Yeah, the rate of change just keeps increasing. So, I think that's why we're seeing what we're seeing ultimately. It's very interesting though, and I think that if anything, it just continues to build confidence that we are coming out of COVID. We are in a whole new economy where a lot of innovation has been accelerated, and it's going to really change the paradigm of how we think about economic growth and how we think about things like inflation and how we measure these things. I think we're in a changing environment that stands to reward investors much more than they realize.
Yeah, I mean, I think the overall takeaway of the yields conversation is that they could come down pretty meaningfully from here. And so kind of watch that. We're going to talk about it a little bit more in the planning room topic when we talk about mortgages and things like that. But that's the 30,000 foot view.
Yeah. And to get back to what we talked about at the beginning on market breadth, just to quickly touch on that, you've had the narrow rally for the past few weeks that anybody, again, thinking long term, you want to see it more broad than narrow. The Dow hit 50, came back down, exceeded it again. Small caps did, in fact, come back and did set a new high. The equal weight did come back and set a new high. And the equal weight is regardless of the company's size. We're seeing these records hit. And just individual companies and stories that me and you follow, we're seeing that. We're seeing these smaller companies that are blowing out earnings and are getting rewarded for it for the first time in a long time. You're having all these things happen simultaneously with the large cap indexes. It means the advance is not being carried by a handful of names anymore. And that's very good, very encouraging for all of, again, our long-term investors, our 401k participants. You want to see that.
Yeah, I saw yesterday there was somebody that tweeted, I don't know who this is, an analyst or something, that tweeted about the value line geometric index breaking through its multi-month resistance, closing at 4-year fresh highs. So that's widely viewed as a gauge of sort of the median stock of the market's performance. And so you're seeing that hit a 4-year high. That's a good sign. You want to see that because that's indicative of the health of the broader market and not just these AI plays or these infrastructure plays that we've been seeing over the last, 30, 45 days.
Yeah, no, 100%. 1 week obviously doesn't make a trend, but that type of data helps build the case for a trend developing and sustaining itself. And again, we mentioned before we flipped the cameras on, we were talking about some of these companies that we follow that are finally getting rewarded a little bit for their innovation and things they're doing with productivity and artificial intelligence, but they're not the big names. And you had last year the discussions of the AI bubble where they're building all this stuff out. Is anybody going to use it? Yes. You have to build all this stuff out. You have to fill them with server racks. You have to fill them with tons of fiber optic and copper. You have to have your temperature control mechanisms. So everybody's making money along the way for building these things, NVIDIA and the big hyperscalers. But once it's all said and done, somebody has to use those tokens. Somebody has to use those GPUs to generate a valuable output. And so now we're starting to see that transition away from just the hyperscalers, saying, oh my God, we're making so much money, to now we're seeing the companies that are actually going to be using the data.
Well, it's gone from theoretical to
to real
practical.
World. Yeah. And that's help to broaden the rally. So we're going to, definitely pay attention. And, so far we seem to have a good handle on how this story is playing out since March, and the yields doing what they did is backing that up. And that's a good thing to see, because that really brings us into the planning room, because we talk about yields, and as individuals that own risk assets, we manage clients' portfolios, we allocate to risk assets, yields coming down is a very positive thing. We like to see that. But there's another aspect of it that's often not talked about, and that is these yields directly control mortgages. So there's a lot of people out there that have some pretty high mortgage rates since 22, 23.
Yep.
So is now the time?
Yeah, well, if we have a conversation about that, we have to start with the basics. Because I think that refinancing, particularly in mortgage environments, is kind of one of those topics where people either jump at any rate movement or they kind of entirely ignore it. There's no happy medium. There's kind of no in between there. And both of those instincts can potentially cost you money over time.
Yeah. So when you look at refinancing, we know that it's where you replace your existing mortgage with a new one, ideally at a lower interest rate. Your old loan's paid off, your new loan starts, and if the new rate's lower, your monthly payment goes down. Or you can use it to reamortize your loan, maybe keep the same payment, but your loan gets paid off faster. Yeah.
So the things to think about, though, when you're having that conversation or going through it internally, or maybe you and your spouse are talking about, should we refinance? The catch here is that it isn't free oftentimes. Sometimes there are companies that you can find, banks that you can find, that will do a very low cost or even no cost refinancing, and they have their different metrics for how they make their money on the backside of that. But there are typically closing costs involved, somewhere in the range of 2 to 5% of the loan amount, generally speaking. So you got a $400,000 mortgage, it could mean anywhere from $8,000 to $20,000 in upfront costs. So the question the question you have to frame isn't just, is the new rate lower? It's, is the new rate lower to justify the cost of getting there? That's kind of the way you want to frame the question.
You want to figure out your break even, right?
Right.
You want to figure out your break even calculation. It's probably the single most important number when considering refinancing.
That's correct. Yes. Here's how that works. The total closing cost of the refinance, you take that number and you divide it by the amount you'd save on your monthly payment. The result of that is the number of months that it's going to take to break even, or really kind of think of it as the recoup of the cost of refinancing through your savings. That's the break-even point that we're talking about.
Yeah. So if you have $8,000 in closing cost, and that refinance lowers your payment by $200, take $8,000 divided by 200. That's 40 months.
A little over 3 years.
Yep. And so if you plan to stay in the home longer than 3 years, it makes sense to do. If you're planning to move into, no, it does not make sense to do.
Yeah. So the break-even calculation, there's a starting point. Also, whether you're going to stay in the house, that's a big one too that people often overlook. But the break-even calculation, a lot of times, is your starting point for that conversation. So before you talk to a lender, definitely know your current rate, sort of estimate what a new rate might look like for your specific situation based on your credit ratings and all that kind of stuff, and have a sense of how long you plan to stay in the house, because that is a big variable to it.
Yeah. And so while the mortgage doesn't track exactly, the 30-year Treasury is not your mortgage rate, but there's typically a little spread that goes in there, but it tracks it. The movement is tracked closely. They move in the exact same direction, even though they're not at the exact same rate. But if you took out a mortgage 23, 24, maybe towards the end of 22, current environment could absolutely represent an opportunity to start reassessing, how much are you paying and how much can I save?
Yeah, and you can ask yourself that, whether it makes sense right now. Kind of depends on the rate you're at. So if you're sitting at, like, say, a 7.5% rate, and they've come down to mid to upper sixes, math may already work in your favor, depending on what size your loan is, what your timeline is. If you're at 6.5% and move to 6%, it may not even clear the break hold threshold. So that may end up costing you, unnecessarily.
Yeah, and I don't think, everybody's situation is different. I would encourage people to, if they think they're a candidate for a refinance, to either lower their monthly payment or to pay off their home quicker, whichever they value most in that decision. It's the time is to start paying attention. It may not be the time necessarily to pull the trigger, because if all of these things that, again, we have to wait and see. But my opinion on it is that, these things begin to resolve themselves. So you're looking 3, 6, 9 months later from now, that could be the no-brainer moment to actually pull the trigger and do that. But you want to, at least if you think you're a candidate for it, you want to start doing your research, go online, use some mortgage calculators, and start figuring out, where does this fit in my retirement plan, my financial plan? And again, am I staying in the home? Because that's really, honestly, the biggest. I know that me and you probably are never going to refinance.
No.
Because we got them so low. I mean,
there's a lot of people in that boat too that got really low mortgages, and that's another reason why they don't want to move, they don't want to leave. So you got your housing inventories is another kind of direct line item from this whole conversation. But it's just something to think about. It's something to really do your research on. You have to remember that trying to time the perfect rate is the exact same mistake we've talked about before with timing the market. It's a problem. You don't have to catch the absolute low.
Yeah.
You need to find the rate that makes the most sense for you and the math that works for your situation, and then formulate your plan of how you want to go about it.
And when you get ready and you think that the rates are attractive enough, interview a few different lenders. Don't just go with the first one. Use a national lender, use a local lender, and try to just see who's given the best opportunity, because like you're saying, there's some that are doing no cost. The refinance market's been dead for years. Mm-hmm. So there are companies hungry out there for business. And so they may offer some really, no cost refis that could make sense. And it can be, the bottom line on it all, it's a genuinely powerful move when the timing is right. Like I said, you don't have to get it exactly right, but when the math makes sense, you can either pay off your home faster, which is always a great thing going into retirement, or if you were really stuck at these high mortgage rates and paying, kind of an absurd payment relative to what the rest of the country was just a few years before that, then you may want to be able to give yourself a break, and you can take that money and stick it in your 401k, stick it in your Roth IRA instead of just paying the interest away. So, it's a great thing to start to consider and speak to. We don't do anything with mortgages. If you have a financial advisor that's delving into mortgages, you need to talk to us. But we do advise on it quite often, and we're more than happy to talk you through it and see if it makes sense.
Well, we advise on the math behind the situation.
Yeah, exactly. And again, it all depends on what you value. But those are the two things you got to look at. Can I pay my home off faster, or can I meaningfully lower my mortgage rate to maybe free up cash to better solidify another aspect of my balance sheet?
Yeah, I think we say maybe at least 3. Interview 3. We kind of cross the board, whether you're looking at mortgage refinancing or another thing a lot of people don't look at as frequently as they should. Home insurance. Home insurance, auto insurance, all these kind of things. 3 seems to be the magic number. Get 3 quotes, look at them. Don't drive yourself crazy trying to get a ton of them, but at least 3, and look at kind of the situation at a 30,000 foot view and see whether it makes sense. The formula is very simple. Lay it out there for you. Figure out if it makes sense for your situation. But yeah, it's a good conversation to have.
And falling yields will bring down homeowners insurance premiums too. Talk about that on another show if you want, but
we'll write it down.
Yeah, it will do that as well, or at least stop the rate of change that's been happening in the homeowners insurance. I know mine's gone up 50%.
Yeah,
50. My car insurance has gone down by
mine just went down
30%.
Yeah,
I got it. So January it went down, and then I got the June notice it went down. So I'm not going to argue with it.
Don't say anything.
Nothing at all.
Now it's going to go back up.
Yes,
because you talked about it. You threw it out there.
Yeah, it probably is. Well, listen, this has been a great rebound. We're really back to that feeling in January that we all had. We are eternally optimistic about what the future holds because we plan for it. And when you make a plan and you stick to it, you don't have to worry about day-to-day things and week-to-week changes or even month-to-month changes because you have a long, steady plan. And these 9 weeks of gains have been great, but we're looking for the next 90 weeks. We're looking out much further. We're happy to see the market broadening. We're happy to see yields reversing lower. And we're also happy to see oil pulling back. The direction of travel is encouraging, and I'm happy to be along for the ride.
Yeah, we'll keep an eye on the data ahead. Got inflation data, employment earnings, all that kind of stuff. They'll kind of piece together the constructive story and see if that holds out. So we'll be watching that. But, that's been good returns. Thanks for joining us.
Yeah, enjoy the weekend. Questions, concerns, always reach out to us, momentumwealth.us. Of course, if you're a client of the firm, you have our phone numbers, you have our email addresses. Always feel free to reach out anytime. We appreciate each and every one of you, and we are so happy that you're listening to us and allowing us to be a part of your financial decision making.
Yeah, subscribe if you haven't. Share it with somebody who you think would find value in it, and we will see you back here next week.
See you then.
Bye-bye.